All right, let's dive into something that's shaking up the entire world of energy. We're talking about a change that hits everything, from your wallet all the way to global politics. So yeah, let's get right into it.
So, this whole thing kicked off with a decision that, at first glance might have seemed pretty routine. OPEC Plus announced they were extending their oil supply cuts. But here's the thing, this wasn't just another temporary tweak. No, this was a major signal, a sign of a really profound change in their whole strategy.
And this quote, this right here, is the absolute key to understanding everything. For decades, right, we could basically count on the big oil producers to step in, open up the taps, and cool down prices whenever things got crazy. They were the world's shock absorbers. Well, it looks like that era is officially over. They've decided they're playing a whole new game now.
So that's the million-dollar question we're tackling today, isn't it? We're going to break down exactly what this new playbook means for investors, for entire countries, and yeah, for the price you end up paying for, well, pretty much everything.
Okay, so first things first, we have to get our heads around the idea that this isn't just about cutting production for a little while. This is a complete fundamental pivot. They're moving away from a short-term tactic and locking in a long-term strategy.
And you can really see the difference here. The old way, totally reactive. Prices would go nuts and they jump in to fix it. But the new way, it's all proactive. They are intentionally creating what they call structural discipline. That just means they're holding back their extra supply on purpose to manage the market for the long haul. They're putting their own price stability way ahead of smoothing things out for the rest of the world.
This brings us to the core idea behind all of this: managed scarcity. Think about it like a faucet. Instead of turning it on full blast when everyone's thirsty, they're just keeping it partially closed, on purpose. And the goal here isn't just a one-time price spike, it's about building a stable, high floor for oil prices. They want prices to be predictable, and predictably high.
And this changes everything, especially if you're paying attention to the markets. What this does is it transforms oil from this, risky up and down cyclical trade into something else entirely. It's now being framed as a durable inflation hedge, a stable strategic asset, something you buy to protect your money. So what happens when an asset suddenly looks stable and predictable? Well, money follows, and that's exactly what we're seeing. Capital is flowing back into the energy sector, and I mean in a big way. For years, the big story in investing was ESG, environmental, social, and governance. That whole movement put a ton of pressure on investors, and a lot of big money actually moved away from fossil fuels. But now, with the promise of these stable, high returns, well, that trend is starting to reverse. The tide is turning.
And the logic for investors is actually pretty simple. It's a three-step process. 1, OPEC Plus creates a predictable price environment. 2, those stable prices mean energy assets generate reliable, predictable cash. And 3, that predictability acts like a giant magnet for big money. We're talking private equity, sovereign wealth funds. They're all jumping back in, positioning for sustained returns.
And listen, it's not just about buying stock in the big oil companies anymore. The money is getting smarter. It's targeting long-term assets, crucial infrastructure like pipelines and storage tanks, that's the midstream stuff that physically moves the oil around, and even the government bonds of oil-producing countries. All of these are now seen as ways to play this new game of managed scarcity.
Now, a shift this massive doesn't just happen in the financial markets, of course. It sends huge geopolitical ripples across the globe. And, like any big change, it creates some very clear winners and some very clear losers.
And you can see that divide right here. If you're a country that produces and sells oil, this is fantastic news. It's short-term fiscal relief, it helps balance your budget, it's a lifesaver. But if you're a country that has to import all that oil, it's a whole different story. You're now facing a structurally higher oil price, which makes fighting inflation a nightmare and might even stop your central bank from being able to cut interest rates.
So really, to boil it all down, what one side sees as a brilliant strategic opportunity, the other side sees as a massive long-term economic headache that just won't go away.
All right, let's zoom out for a second and try to see the bigger picture. When you put all these pieces together, what does it all mean? What is oil's new role on the world stage?
And this right here is really the main takeaway. By grabbing the reins of supply, OPEC Plus has completely changed what oil is in the global economy. It's gone from being this volatile, almost chaotic commodity to a carefully managed strategic asset. It's a key piece on the global chessboard now. And this is the new reality we all have to live with. For capital markets, it means pricing in energy scarcity much more seriously. For governments and producing nations, it creates this intense pressure to use the extra money wisely and actually reform. And for all of us, it means oil is now more than ever a central driver of inflation, geopolitics, and pretty much any long-term strategy.
Which kind of leaves us with one final big question. OPEC Plus is creating price stability for sure, but that stability clearly comes at a price for everyone else. So as we head into this new era of managed energy, you have to ask, what is the true price of stability, and who is the one that's going to end up paying it?